Before we dive in, please remember that the information provided in this video is for educational and entertainment purposes only. I am not a financial advisor, a lender, or a real estate professional. The numbers and scenarios presented are illustrative examples and will vary based on your personal financial situation, location, and market conditions. You should always consult with qualified professionals before making any financial decisions, especially one as significant as buying a home. Alright, let's get straight to it. A friend of mine, we'll call him Jason, called me a few months ago, absolutely freaking out. He and his wife had just bought what they called their forever home for $600,000. They were on top of the world. They'd used an online calculator, plugged in the numbers, and saw a monthly payment they thought they could handle. But then the first bill came, and it wasn't just a little higher. It was nearly $900 more per month than they had budgeted for. $900. That's a car payment. That's a vacation. For them, it was the difference between living comfortably and living in a state of constant financial anxiety. What went wrong? They fell for the biggest lie in real estate, the simple mortgage calculator. That little box you type numbers into on a bank's website? It's designed to give you the most optimistic number possible. It's a marketing tool, not a financial planning tool. Tells you a partial truth. And in the world of six-figure debt, a partial truth is a lie that can absolutely wreck your financial future. Today we are going to expose that lie. We are going to break down the real, all-in, no surprises monthly cost of a $600,000 mortgage in the United States. We're not just going to scratch the surface. We're going deep into the 5 essential components of your payment, the parts that Jason and millions of other homebuyers completely miss. By the end of this presentation, you will understand your mortgage payment better than 99% of the population. You will be able to spot a bad deal from a mile away and walk into a conversation with a lender with total unshakable confidence. So let's build this from the ground up. The number everyone knows, the one the online calculators love to show you, is made of 2 parts: principal and interest. P&I. Let's start with principal. This is the easy one. The principal is the amount of money you actually borrow. So, if you're buying a $600,000 house, you're probably not borrowing the full $600,000. You're making a down payment. The standard, most talked about down payment is 20%. 20% of $600,000 is $120,000. So, you bring that cash to the table and the bank lends you the rest. That means your starting loan amount, your principal, is $480,000. For the rest of this video, we're going to use that $480,000 loan as our main example. Every month, a piece of your payment goes toward chipping away at that massive number. In the beginning, it's a tiny sliver. At the end of your loan, it's a huge chunk. But every single principal payment you make builds your equity, your ownership in the home. It's the part of the payment that's actually for you. Now for the second part, the one that's not for you. Interest. Interest is the price of the loan. It's the fee the bank charges you for the privilege of using their $480,000 to buy a house. It's expressed as a percentage, the interest rate. And this single number, this 1%, is the most powerful and dangerous variable in your entire financial life. A tiny 1% change in your interest rate can have a catastrophic or a fantastic impact on your wallet. Let's make this real. We'll use our $480,000 loan on a standard 30-year fixed-rate mortgage. A 30-year term is the most common in the U.S., meaning you have 360 monthly payments to clear your debt. Let's look at 3 different interest rate scenarios that are all very realistic in today's market. Scenario 1, the 7% rate. This has been a common rate recently. At 7% interest on a $480,000 loan, your monthly principal and interest payment, just the P&I, is $3,193. Write that down. $3,193. Now here's the absolutely insane part. If you make that payment every single month for 30 years, you will have paid the bank a total of $669,480 in interest alone. You borrowed $480,000, but you paid back over $1.1 million. You paid more for the loan than you did for the house itself. That's what a 7% rate does over 3 decades. It's brutal. Scenario 2, the 6% rate. Let's say you have a better credit score, or you shop around, or maybe the market just shifts in your favor and you lock in a 6% rate. What happens to our payment? That same $480,000 loan now has a monthly P&I payment of $2,877. That's a difference of $316 a month. Per month. That's over $3,700 a year back in your pocket. That's your grocery bill, your gas, your utilities. It's a huge deal. And the total interest paid over 30 years? It drops to $535,720. You just saved yourself over $133,000 in interest payments simply by getting a rate that was 1 percentage point lower. This is the game right here. Scenario 3, the 5% rate. Let's imagine a world where rates cool off and you snag a fantastic 5% rate. Now your monthly principal and interest payment on that $480,000 loan falls to $2,576. Compared to the 7% rate, you are now saving $617 every single month. That is life-changing money. That's $7,400 a year. Over the life of the loan, the total interest you pay is only $407,360. You have saved over $250,000 in interest compared to the person who got the 7% rate. $250,000 for the exact same house. Do you see the power of that one single number? The difference between a 7% world and a 5% world isn't just a few bucks. It's the difference between building wealth and barely treading water. It's why your credit score is so incredibly important. It's why you have to shop around for your mortgage with multiple lenders. Don't just walk into your local bank and take the first offer they give you. That could be a $250,000 mistake. But here is the critical point, the reason my friend Jason was panicking. This number, this P&I payment, whether it's $3,200 or $2,600, is not your monthly mortgage payment. It is the foundation. It is the starting point. It is the lie the calculator tells you. The real payment includes 3 other silent, non-negotiable costs that are bolted on top of this number. These are the costs that turn a manageable payment into a budget-breaking nightmare. The banks know about them. The real estate agents know about them. And now you're going to know about them too. The full true cost of homeownership is what we call PITI: principal, interest, taxes, and insurance. And there's often a 5th phantom cost we need to talk about too. These last components are where the dream of homeownership can turn sideways, and it's where we're going next. We've built our foundation with principal and interest. Now let's add the first of these budget killers: property taxes. Property taxes are the silent partner in your mortgage. They're the payment that never ever goes away. Even after you've burned the mortgage papers in a celebratory bonfire 30 years from now, your local tax assessor will still be sending you a bill. This isn't some optional fee. It's the non-negotiable price of admission to a community. It's what pays for the public schools your kids might attend, the fire trucks that show up if the worst happens, the police officers on patrol, the roads you drive on, and the libraries where you borrow books. It's the financial engine of local America. But here's the critical multi-$1,000 question. How much is it? The answer is terrifyingly vague. It depends. It depends on a scale so massive that it can single-handedly make the same exact house affordable in one town and a financial nightmare just a few miles away. To understand this, let's take our $600,000 house and place it in 2 different parts of the country. We're not even changing the house, same square footage, same number of bedrooms, same 2-car garage. Let's imagine a family, the Millers, buys this house in a suburb of Denver, Colorado. And another family, the Jacksons, buys the identical house in a suburb in New Jersey. Both families have the same mortgage, the same interest rate, and the same principal and interest payment of roughly $3,450. But their total monthly payments will be wildly different. Let's start in Colorado. The state has one of the lowest average property tax rates in the nation, sitting around 0.48%. Now, taxes aren't based on what you paid for the house, but on its assessed value. This is a number the local government assigns to your property for tax purposes. It's often a little less than the market value. For our $600,000 home, let's say the assessed value is $550,000. In Colorado, at a rate of 0.48%, the Miller family's annual property tax bill would be about $2,640. Divide that by 12 months and you get $220 per month. So the Millers' total payment for principal, interest, and taxes is about $3,670. Manageable. Now let's fly across the country to New Jersey, home to some of the highest property taxes in the United States. The average rate there is a staggering 2.23%. The Jacksons buy the exact same $600,000 house. The assessor agrees, valuing it at the same $550,000. But when we apply New Jersey's rate, the math becomes brutal. 2.23% of $550,000 is $12,265 a year. Per year. Divide that by 12, and the Jacksons are paying $1,022 a month, just in property taxes. Their total monthly payment? It's their $3,450 mortgage payment plus that $1,022 tax bill. That comes to $4,472 a month. Let this sink in. The Millers and the Jacksons bought the exact same house for the exact same price. But the Jacksons are paying $802 more every single month. That's nearly $10,000 a year. That $800 difference is a luxury car payment. It's a family vacation to Disney World every single year. It's a massive contribution to a college fund or a retirement account, completely wiped out by the invisible lines on a map. This isn't an exaggeration. It's the reality for millions of American homeowners. The difference comes down to how local governments are funded. States like New Jersey rely very heavily on property taxes to fund their world-class schools and services. Other states use a different mix, leaning more on state income tax or sales tax, which spreads the burden across a wider range of activities. But the danger of property taxes isn't just their size. It's their unpredictability. Your fixed-rate mortgage payment of principal and interest is a rock. It will be the same on day 1 as it is in year 29. Your property tax payment is quicksand. First, your home's assessed value can change. If your neighborhood suddenly becomes a hot spot and home values shoot up, the tax assessor will eventually notice. They'll perform a reassessment, and suddenly that $550,000 assessed value could become $650,000. Your tax bill just got a 10 to 15% raise even if your income didn't. Second, the tax rate itself can change. Did your town just vote to build a brand new state-of-the-art high school with an Olympic-sized swimming pool? That's fantastic for the kids. But they're going to pay for it by raising property taxes on you and your neighbors. This is where homeowners get hit with something called escrow shock, and it is a truly nasty surprise. Most lenders require you to have an escrow account. This means that each month, you're not just paying your principal and interest. You're also paying an extra amount, an estimate of 1/12 of your annual property tax bill, and your homeowner's insurance premium. The lender holds this money for you in the escrow account, and then pays your tax and insurance bills directly when they come due. It's convenient, but it's based on an estimate. Imagine you're the Jacksons in New Jersey. The bank estimated your taxes would be about $1,000 a month. So for the first year, you're paying your P&I plus $1,000 and everything feels fine. But at the end of the year, the town sends the actual tax bill to your lender, and it's not $12,000. Because of a small rate increase, it's actually $13,200. Your lender has to pay it, but you only gave them $12,000. So now your escrow account has a $1,200 hole in it. It's a shortfall. You're going to get a letter in the mail that will ruin your day. It will say two things. First, you have to pay back that $1,200 shortfall. They might demand it in a lump sum or, if they're nice, spread it out over the next 12 months, adding an extra $100 to your payment. Second, and more importantly, they're going to adjust your future escrow payments to reflect the new higher tax bill. Your new annual tax is $13,200, which is $1,100 a month. So your monthly escrow payment is going up by $100 to cover the new baseline. Add it all up. Your monthly payment just went from $4,450 to $4,650. A $200 a month jump seemingly out of nowhere. That's escrow shock. It's the moment you realize that your housing budget is not as fixed as you thought it was. So how do you protect yourself? First, before you even make an offer on a house, you must become a detective. Don't trust the mortgage estimate on a real estate app. Go directly to the county tax assessor's website. You can look up the exact property tax history for the address you're considering. See what the current owner is paying. See if it's been going up steadily over the past few years. Second, ask your real estate agent about the local situation. Are there any major town projects or school bonds coming up for a vote? Is the entire area due for a reassessment? A good agent should have their finger on the pulse of these issues. And third, know your rights. If you believe your home's assessed value is significantly higher than what similar homes in your neighborhood have recently sold for, you have the right to appeal your assessment. It's a formal process and it requires you to present evidence, but a successful appeal can save you thousands of dollars a year. So let's update our scoreboard. For our $600,000 house, the monthly payment isn't just the $3,450 of principal and interest. It's at least $3,670 in a low-tax state, and it could easily be $4,472 or more in a high-tax state. That's the power of property taxes. But property tax is only one of the 2 forever payments you'll make. The next one is just as variable, just as location dependent, and it's designed to protect you from the one thing you can't predict: disaster. I'm talking about homeowners insurance, and the price of that protection is skyrocketing in ways you won't believe. Homeowners insurance used to be a sleepy, predictable part of your mortgage payment. A few $100 a month, maybe. An afterthought. Not anymore. We are living through a fundamental repricing of risk in America, and your mortgage payment is on the front lines. The core idea of insurance is simple. You pay a small, regular amount called a premium to protect yourself against a massive, catastrophic loss, like your house burning down. The insurance company pools everyone's premiums to pay for the few people who actually have a disaster. But what happens when the disasters stop being rare? What happens when once-in-a-century storms start happening every few years? That's what's happening right now. In the last 5 years, the U.S. has been hit by a relentless barrage of billion-dollar weather and climate disasters. Wildfires in California and Colorado, hurricanes in Florida and Louisiana, massive hailstorms in Texas, tornadoes ripping through the Midwest. Insurance companies, which are for-profit businesses, are looking at their spreadsheets and seeing red. They're paying out claims at a rate they never anticipated. Add to that the soaring cost of construction materials and labor due to inflation and supply chain issues. Rebuilding a destroyed home today costs vastly more than it did just a few years ago. So what do? They have 2 choices: raise prices dramatically, or stop offering insurance altogether in high-risk areas. And they are doing both, creating 2 completely different Americas when it comes to the cost of homeownership. Let's imagine 2 people, both getting that same $600,000 mortgage. First, we have Sarah in Columbus, Ohio. Ohio has its share of weather, tornadoes, winter storms, but it's not considered a catastrophic risk zone like the coasts. Sarah shops for homeowners insurance. She gets a few quotes. For a $600,000 house, her policy might cost around $1,800 a year. That breaks down to just $150 a month that gets added to her mortgage payment through her escrow account. It's a manageable, predictable cost. For that $150 a month, she gets what's called an HO3 policy, the most common type. It covers damage to her house from all disasters except those specifically excluded, like floods, earthquakes, or sinkholes. It also covers her personal belongings and, crucially, it provides liability coverage. That means if the mailman slips on her icy steps and sues her, her insurance helps cover the legal bills and settlement. For Sarah, insurance is just part of the budget. It's boring, and that's a good thing. Now let's meet David. David is buying a house for that same $600,000, but he's in Miami, Florida. And for David, getting insurance is an absolute nightmare. First, many of the big-name national insurers you see on TV, companies like State Farm and Allstate, have either stopped writing new policies in Florida or have pulled out of the state entirely. They've lost billions from hurricanes and have decided the risk is just too high. So David has to turn to smaller, Florida-specific insurance companies he's never heard of. These companies have less cash in reserve, and several have gone bankrupt in recent years after major storms, leaving homeowners in a lurch. After weeks of searching, David finally gets a quote. It's not $1,800 a year. It's $9,000 a year. And that's if he's lucky. In some parts of Florida, that same coverage could be $12,000 or more. Let's stick with $9,000. That's $750 a month. $750 every single month just for insurance. That's 5 times what Sarah is paying in Ohio for the exact same priced house. Suddenly, David's affordable mortgage payment has exploded. That extra $600 a month is the difference between comfort and being house poor. And the pain doesn't stop there. David's policy has a separate, much higher deductible specifically for hurricane damage. While his standard deductible for something like a fire might be $1,000, his hurricane deductible is a percentage of the home's insured value. A typical 2% hurricane deductible on his $600,000 home means he has to pay the first $12,000 of damages out of his own pocket before the insurance company pays a single dime. But wait, it gets worse. That $9,000 policy, it doesn't cover the single biggest threat in Miami: flooding. Damage from storm surge during a hurricane is considered flood damage, and it is explicitly excluded from standard homeowners insurance policies. To cover that, David has to buy a separate flood insurance policy, usually from the federal government's National Flood Insurance Program, or NFIP. Depending on his home's exact location and elevation, that could add another $1,000 to $3,000 a year to his costs. So now his total insurance bill is pushing $12,000 a year, or $1,000 a month. This isn't just a Florida problem. Go to California. You'll find homeowners in wildfire-prone areas who are completely uninsurable on the private market. They're being dropped by their longtime insurers and forced onto the state's insurer of last resort, the FAIR Plan. The FAIR Plan offers basic, bare-bones fire coverage at an exorbitant price, and it doesn't include liability or theft. To get that, you have to buy another separate policy. It's common for California homeowners in these areas to pay over $10,000 a year for a patchwork of policies that still don't offer the same level of protection as Sarah's simple $1,800 policy in Ohio. So when you see a national average for homeowners insurance, maybe around $1,900 a year, understand that it is a completely meaningless number. It's like averaging the temperature in Alaska and Arizona to get a national temperature. It tells you nothing about the reality on the ground. The single most important factor in your insurance cost is your home's specific address and its vulnerability to catastrophic weather. This is why you absolutely must get insurance quotes before you make an offer on a house. Don't just rely on the seller's current insurance cost. Rates may have skyrocketed since they bought their policy. Don't just assume it will be affordable. Call an independent insurance agent. They can shop multiple carriers for you, and give them the address of the property you're considering. Find out the real cost. Find out if the home is in a flood zone. Ask about the age of the roof, because in states like Florida, a roof older than 15 years can make a home almost impossible to insure. The cost of insurance is no longer a rounding error in your housing budget. For a growing number of Americans, it is a deal breaker. It's a second mortgage payment you pay for the privilege of protection. It's a variable that can and will increase every single year, regardless of what happens to your mortgage interest rate. It is the wild card in the PITI formula, capable of turning a dream home into a financial anchor. You're now paying for principal and interest, the bank's money, and you're paying for insurance, the protector's money. But there's a third entity that demands its cut, an entity you cannot negotiate with, cannot switch, and cannot escape. They don't care about your interest rate, and they don't care if a hurricane is bearing down on your coast. They only care about what your property is worth, and they will send you a bill for their share every single year, forever. I'm talking about the government's piece of your property pie, property taxes. And this silent, unavoidable cost can be the most shocking of them all. Think of property taxes as the eternal subscription fee for owning a piece of land in America. You never truly own it free and clear from the government. They are your silent partner, and their share is non-negotiable. So, how do they figure out how much you owe them for the privilege of living in your own house? It's a two-part formula that sounds complicated, but it's actually pretty simple when you break it down. First, your local government determines your home's assessed value. This is a crucial point. They don't usually tax you on the full $600,000 market price you paid. Instead, a county official, called an assessor, calculates a separate value for tax purposes. This assessed value is often a percentage of the market value, and that percentage can vary wildly from place to place. In some areas, it might be 90% of what your home is worth. In others, it could be as low as 10 or 20%. This is the first lever that makes property taxes so different across the country. The second part of the formula is the tax rate itself, often called a mill rate or millage rate. The word mill is just a fancy term for 1,000th. So, 1 mill is equivalent to $1 of tax for every $1,000 of assessed value. Your city, your county, your local school district, they all set their own mill rates based on how much money they need to fund their budgets for the year. They add all those little rates together to get your total tax rate. But let's cut through the jargon. The easiest way to understand the real-world impact is to look at the effective tax rate. This is a simple percentage that tells you what you're likely to pay in taxes each year, based on your home's market value. And this is where the $600,000 American dream can turn into a financial nightmare, depending entirely on your zip code. Let's take our $600,000 house on a road trip across the United States to see how this plays out. First stop, Honolulu, Hawaii. The Aloha State has the lowest effective property tax rate in the nation, sitting at a beautiful sunny 0.29%. You take your $600,000 home, multiply it by 0.29%, and you get an annual tax bill of just $1,740. Divide that by 12 months, and you're adding only $145 to your monthly mortgage payment. That's manageable. It's less than a family's cell phone bill. Now let's pack up our hypothetical house and move it all the way to the Northeast to Bergen County, New Jersey. New Jersey has one of the highest effective property tax rates in the country, hovering around 2.47%. We take the exact same $600,000 house, but now we multiply it by 2.47%. The annual tax bill is no longer $1,700. It's $14,820. Divide that by 12, and your monthly addition for property taxes is $1,235. Let that sink in for a moment. This isn't a different house. It's not a bigger house. It's the same $600,000 asset. But in one state, it costs you $145 a month in taxes, and in another, it costs you over $1,200. That is a difference of more than $1,000 every single month. That's a brand new luxury car payment. That's a mortgage payment on a small rental property. That is the fundamental difference between building wealth and struggling to stay afloat. $1,000 a month can completely change the financial trajectory of a family. So why the insane difference? It all comes down to how state and local governments choose to fund themselves. States like New Jersey and Illinois rely heavily on property taxes to pay for their excellent, but very expensive public schools, police departments, and infrastructure. States with low property taxes like Hawaii or Alabama might rely more on high-income taxes or sales taxes to fill their coffers. There is no free lunch. The government gets its money one way or another. You just have to decide which form of taxation you're most willing to live with. Now, here's how this all gets tied back into your monthly payment. Your mortgage lender has a vested interest in making sure you don't forget to pay your property taxes. Because if you don't, the government can put a lien on your property and, in a worst-case scenario, even foreclose on it, bypassing the bank entirely. The bank does not want that. So, to protect their investment, they set up something called an escrow account. Think of it as a forced savings account for your home-related expenses. The lender estimates what your total annual property tax bill will be. Let's use our New Jersey example. $14,820. They divide that by 12, which gives you $1,235. Then they add that amount directly onto your monthly mortgage payment. So your payment isn't just that $3,840 in principal and interest we calculated earlier. No, you now have to add $1,235 on top of that. Suddenly, your monthly payment for that $600,000 house has ballooned to over $5,000. You send one check to the lender, they peel off the P&I for themselves, and they put the tax portion into your escrow account. When the big tax bill comes due, they pay it for you automatically from that account. It's convenient, yes, but it dramatically inflates your monthly cost of living. And here's the final brutal truth about property taxes. They are not fixed. Even if you have a fixed-rate mortgage where your principal and interest payment will stay the same for 30 years, your total monthly payment will not. Your local government will reassess the value of your home every few years. As the real estate market rises, so does your home's assessed value. And when your assessed value goes up, your tax bill goes up right along with it. Furthermore, your town or county can simply vote to increase the tax rate. Do they need a new fire truck? Want to build a new high school? That money often comes from raising property taxes. So while your core mortgage payment is predictable, this chunk of it is a moving target that almost always moves in one direction: up. Your housing costs will slowly creep higher and higher over the life of your loan. It's a reality every homeowner must be prepared for. So you've got your principal, your interest, and now this massive variable chunk for taxes. Your monthly payment is already looking totally different from that online calculator. But we're not done. The bank and Mother Nature require one more layer of financial protection before they'll let you sleep soundly in your new home. It's the cost of protecting your investment from fire, theft, and disaster. And just like taxes, where you live can make this cost either a minor annoyance or a financial nightmare. Let's take two identical homes. Both beautiful, both valued at exactly $600,000. One is nestled in the green hills of Oregon. The other is soaking up the sun in coastal Florida. The owner in Oregon pays about $100 a month for homeowners insurance. A minor line item. The owner in Florida? They could be paying over $500 a month. $500. That's not a line item, that's a car payment for a luxury sedan. Same house, 5 times the cost. Why? Because homeowners insurance isn't about the value of your house. It's about the risk. It's a calculated bet the insurance company makes against Mother Nature. And in America, Mother Nature plays for keeps. Florida is the undisputed heavyweight champion of hurricanes. Its entire existence is a multi-billion-dollar staring contest with the Atlantic Ocean. Oklahoma sits in the dead center of Tornado Alley, a place where the sky can turn from blue to black in minutes. And California is in a constant battle with wildfires, earthquakes, and mudslides. Living in these states means your home is on the front lines of a war with the weather. And that risk? It gets priced directly into your monthly payment. So while the national average for a $600,000 home might hover around $2,000 a year, or about $167 a month, that number is almost meaningless. It's like saying the average temperature on Earth is 60 degrees. That doesn't help you much if you're standing in Antarctica or the Sahara Desert. You need to know the cost for your Sahara, your Antarctica. A quick search for insurance quotes in high-risk zones like Miami or Oklahoma City will show you premiums of $5,000, $6,000, even $10,000 a year. That's over $800 a month, just for the privilege of protecting your home from being blown away or washed out to sea. But what are you actually paying for with that money? What's inside this mandatory, and often infuriatingly expensive policy? Let's crack it open. Most people have what's called an HO3 policy. Think of it as the standard package. It's composed of a few key parts. The first and biggest is dwelling coverage. This is the one that rebuilds your house from the ground up if it's destroyed. Now here's a critical detail most people miss. You are not insuring the $600,000 market value of your home. A huge chunk of that price is the land itself, and you can't exactly burn down a piece of dirt. You're insuring the replacement cost, the price of lumber, labor, roofing, and everything else it would take to reconstruct the physical structure. For a $600,000 property, the replacement cost might be closer to $450,000. That's the number your dwelling coverage is based on. Next up is personal property coverage. This is for all your stuff. Your furniture, your electronics, your clothes, your weird collection of antique teacups. The easiest way to think about it is this. If you could flip your house upside down and give it a good shake, everything that falls out is your personal property. This coverage is usually set as a percentage of your dwelling coverage, typically between 50 and 70%. So if your home is insured for $450,000, you'll have around $225,000 to replace all your belongings. It sounds like a lot, but imagine having to buy every single spoon, sock, and sofa you own all at once. It adds up terrifyingly fast. Then there's the part everyone forgets about until they desperately need it. Liability coverage. This has nothing to do with your house burning down. This protects you if someone gets hurt on your property. Your mailman slips on your icy front steps. A neighbor's kid trips over a sprinkler head in your yard. Your otherwise friendly dog decides he doesn't like the look of the delivery guy. Suddenly, you're not just dealing with a scraped knee. You're dealing with a lawsuit. Without liability coverage, a simple accident could lead to financial ruin, forcing you to sell that very home to pay for legal fees and medical bills. This coverage is your financial bodyguard. And finally, there's the unsung hero of homeowners insurance. Additional living expenses, or ALE. If a fire does make your home unlivable, you still have to, live somewhere. ALE pays for you to stay in a hotel or a rental apartment while your home is being rebuilt. It covers the cost of meals, laundry, and other expenses you incur because you've been displaced. It's the coverage that keeps your life from completely derailing after a disaster. So you've got the house, the stuff inside it, lawsuits, and a place to stay. That's the core of what you're paying for. But the insurance company's calculation doesn't stop there. They dig deeper. They look at the age of your roof. An old roof is a leak waiting to happen. They look at your home's wiring and plumbing. Old systems are fire and water damage risks. They even look at how close you are to a fire hydrant and a fire station. The further away you are, the longer it takes for help to arrive, and the higher your premium will be. But then they start looking at you. And this is where it gets personal. They will pull your credit history. Yes, the same credit score that helped you get the loan in the first place is also used to determine your insurance rate. The industry's data shows a correlation between lower credit scores and a higher likelihood of filing a claim. It's controversial, but it's a reality in most states. A poor credit score can add hundreds of dollars to your annual premium. They'll also ask about things that seem completely unrelated. Do you have a dog? What breed is it? Many insurers have a list of breeds they consider high risk, like pit bulls, Rottweilers, or German shepherds. Owning one can make your premium skyrocket, or even make you ineligible for coverage with some companies. Do you have a swimming pool or a trampoline? In the eyes of an insurer, you don't have a fun backyard toy. You have an attractive nuisance, a magnet for injuries and lawsuits, and they will charge you accordingly. Can feel like you're being penalized from every angle. So how do you fight back? How do you lower this number? First, you shop around vigorously. Don't just take the first quote your mortgage lender suggests. Get quotes from at least 5 different companies, both national brands and smaller local insurers. Second, bundle your policies. If you have car insurance, getting your homeowner's policy from the same company can often lead to a significant discount. Third, raise your deductible. The deductible is the amount you have to pay out of pocket before the insurance company pays a dime. A standard deductible is $1,000. If you raise it to $2,500, you're taking on more of the initial risk yourself, and the insurance company will reward you with a lower premium. It's a gamble, but it can save you hundreds per year. Finally, install protective devices. A monitored security system, smart smoke detectors, even just putting deadbolts on your exterior doors can shave a little bit off your bill. You have to be proactive because this cost, just like property taxes, is not static. It will go up. As construction costs rise, as storms get more severe, your premium will creep upwards every single year. It's a permanent part of your PITI puzzle. So you've paid your taxes to the government. You've paid your insurance to protect your house from disaster. You are now covering the 2 biggest external risks. But there's another, often despised, piece of the payment pie that you might be forced to buy. It's another form of insurance, but it's not for you. It doesn't protect your house. It doesn't protect your belongings. It doesn't protect you from lawsuits. Protects the bank. And for many new homeowners, it's a mandatory cost that can add hundreds of dollars to their monthly payment. It's called PMI, and it's the next hidden cost we need to drag into the light. So, what is this mandatory insurance that only protects the bank? It's called private mortgage insurance, or PMI. And it's one of the most misunderstood and resented costs in all of real estate. But understanding it is the key to defeating it. Let's get one thing straight. PMI exists for one reason and one reason only. Lenders consider you a higher risk if you don't put at least 20% down on a home. Why 20%? Because that 20% equity acts as a massive financial cushion for them. If you stop paying your mortgage and they have to foreclose, they're confident they can sell the house even in a down market and get their 80% back. But when you put down less, say 10% or 5% or even 3%, that cushion shrinks. Their risk goes up. If you default and home values have dropped even slightly, they could lose tens of thousands of dollars. So they came up with a clever solution, a solution that transfers all of that risk directly back to you. They force you to buy an insurance policy that pays them if you default. You pay the premium every single month, but if disaster strikes, you see none of the payout. The check goes directly to your lender to make them whole. It's like being forced to buy your boss a new car, paying for it every month, but you never ever get to drive it. The cost of PMI isn't a small incidental fee. It is a significant monthly expense calculated as a percentage of your total loan amount. This percentage, typically between 0.5% and 2% annually, depends heavily on 2 key factors: your credit score and your loan-to-value ratio, or LTV. A better credit score means a lower PMI rate. A smaller down payment, which means a higher LTV, means a higher PMI rate because the bank is taking on more risk. Let's put this into the context of our $600,000 house. The magic number for avoiding PMI is a 20% down payment. 20% of $600,000 is $120,000. If you can put that much down, your loan is $480,000, your LTV is 80%, and your PMI is 0. You've escaped the trap. But let's be realistic. For most Americans, saving $120,000 in cash is an Everest-level challenge. So, let's say you've worked incredibly hard and saved up 10%, which is $60,000. First of all, congratulations. That is a monumental achievement. But it means your loan amount is now $540,000, and your LTV is 90%. The bank now sees you as a risk, and they activate the PMI requirement. How much will it cost you? Let's assume you have a good credit score, so your PMI rate is a fairly standard 0.75%. We take your loan amount, $540,000, and multiply it by 0.0075. That gives us an annual PMI cost of $4,050. Divide that by 12 months, and you are now paying an extra $337.50 every single month. Let that sink in. $337. That's a car payment. That's a significant chunk of a student loan payment. That's a family's grocery bill for a week. And every month, that money vanishes into an insurance policy that provides you, the homeowner, with absolutely zero benefit. It doesn't rebuild your home if it burns down. It doesn't cover your mortgage if you lose your job. It does one thing. It protects the bank's investment. Over 5 years, that's over $20,000 you've paid for the privilege of being considered a risk. Now let's take it a step further. What if you can only manage a 5% down payment? That's $30,000 on our $600,000 home. Your loan is now $570,000, a 95% LTV. The bank's risk is even higher now, and your PMI rate reflects that. It might jump to 1.1%. So now we take $570,000 and multiply it by 0.011. The annual cost is $6,270. Divided by 12, your monthly PMI payment is now $522.50. $522 every month. Added on top of your principal, your interest, your property taxes, your homeowner's insurance. Suddenly, that affordable monthly payment has ballooned into something much more intimidating. This is the hidden cost that shocks so many new homeowners a month or two after they move in. They budgeted for the mortgage, but they didn't fully account for the massive, non-beneficial cost of PMI. So why would anyone ever agree to this? The answer is simple: access. For many people, PMI is not a choice. It's the toll they have to pay to cross the bridge into homeownership. In a world of rapidly rising home prices and stagnant wages, waiting to save up that full 20% can feel like running on a treadmill that's constantly speeding up. You save $10,000, but the price of the home you want goes up by $30,000. PMI, as expensive as it is, becomes a strategic tool. It allows you to get into the market now, to lock in a price, and to start building your own equity instead of your landlord's. You're making a calculated bet that the equity you gain by owning the home will eventually outweigh the money you're wasting on PMI. But here is the most important thing you need to know. PMI is not a life sentence. You are not stuck with it for 30 years. There is an escape plan, and knowing it is your key to saving thousands. Thanks to a federal law called the Homeowners Protection Act, your lender is legally required to automatically terminate your PMI on the date your loan balance is scheduled to reach 78% of the original value of your home. This happens just by you making your regular monthly payments. But you don't have to wait that long. The law also gives you the right to request cancellation of your PMI once your mortgage balance drops to 80% of the original value. Being proactive and making that phone call can save you months or even years of payments. But that's just the standard route. Here's the secret weapon that can accelerate your escape dramatically: home appreciation. The 80% rule is based on your loan-to-value ratio. Most people think the value part of that equation is fixed at the original purchase price. It's not. It's the current value of your home. Let's go back to our example. You bought the $600,000 house with a 10% down payment, so your loan was $540,000. 2 years go by. You've been paying your mortgage diligently, and your loan balance is now down to, say, $528,000. But during those 2 years, the housing market in your area has been strong. You hire an appraiser, and they determine your home is now worth $680,000. Let's do the math. Your new loan-to-value ratio is your current loan balance, $528,000, divided by your home's new, higher value, $680,000. That comes out to just under 78%. You are now well below the 80% threshold. You can now formally petition your lender with the new appraisal in hand to remove your PMI. If they approve it, that $337 monthly payment is gone forever. You just gave yourself a $337 a month raise, simply by understanding the rules and tracking your home's value. One final critical warning: everything we've discussed applies to conventional loans. There's another popular type of loan, especially for first-time buyers, called an FHA loan, which is insured by the government. These loans have their own version of mortgage insurance, called MIP, or mortgage insurance premium. And with FHA loans, the rules are different and much harsher. If you get an FHA loan today and put down less than 10%, you will pay MIP for the entire life of the loan. It never goes away. The only way to get rid of it is to refinance your FHA loan into a conventional loan once you have enough equity. This is a crucial distinction that can cost you tens of thousands of dollars over the long run if you're not aware of it. PMI is a painful, but often necessary part of the home buying journey for millions. It's the gatekeeper that stands between a small down payment and the front door of your new home. But it's a gatekeeper you can and should plan to defeat. So you've navigated principal and interest. You've learned how to slay the PMI dragon. You're feeling confident. But the PITI acronym, principal, interest, taxes, and insurance, still has two letters we haven't fully explored. And these next two components are fundamentally different. They aren't fixed. They aren't paid to the bank. And they have a nasty habit of increasing over time, raising your monthly payment without any warning. They are property taxes and homeowners insurance, the two variables that are bundled into something called an escrow account. And this account is the next black box we need to pry open. This escrow account is your lender's way of making sure the two most critical bills associated with your house get paid, bills that could actually jeopardize their investment if you defaulted. Think of it like a forced savings account. Every month, along with your principal and interest payment, you give the lender a little extra money. They don't keep it. They put it into this separate protected account. Then when your property tax bill is due, or your homeowner's insurance premium needs to be paid, they dip into that account and pay it for you. Why do they care so much? It's simple. They own most of the house. If you stop paying property taxes, the county can put a lien on your home and eventually foreclose on it, potentially wiping out the lender's position. They would lose their collateral. Similarly, if your house burns to the ground and you don't have homeowner's insurance, that $600,000 asset they gave you a loan for is now a pile of ash. The escrow account is their insurance policy against your potential neglect. So let's dissect the first and often most expensive component they collect for: property taxes. This is the money you pay to your local government, your city, your county, your school district, to fund everything that makes your community run. We're talking about public schools, police and fire departments, road maintenance, libraries, parks. It's the cost of civilization, baked right into your homeownership journey. But the way it's calculated is where things get incredibly tricky and wildly different depending on where you live. It starts with your home's assessed value. This is not necessarily what you paid for it. This is the value the local tax assessor assigns to your property for the specific purpose of taxation. They might reassess every year or every few years. Then, they multiply that assessed value by something called a millage rate or tax rate. A mill is 1/1000th of a dollar. So a tax rate of, say, 20 mills means you pay $20 for every $1,000 of assessed value. The result is your annual property tax bill. And this is where the American dream gets a reality check. The difference in property tax rates across the country is staggering. It is the single biggest variable that can turn an affordable home into a financial burden. Let's take our $600,000 house. In a state like Hawaii or Alabama, you might pay as little as $3,000 or $4,000 a year in property taxes. That's about $250 to $330 a month that gets added to your mortgage payment. Manageable. Now let's move that same $600,000 house to New Jersey, Illinois, or New Hampshire. Suddenly, your property tax bill could be $14,000, $16,000, even $18,000 a year. That's not $300 a month. That's $1,500 a month. That's more than the principal and interest payment on a $250,000 loan. It completely changes the financial DNA of the home. This is why you hear horror stories of people who can afford the mortgage, but they get absolutely crushed by the taxes. They are house rich and cash poor, with a massive chunk of their income going straight to the local government just for the privilege of living there. And here's the insidious part. It's not fixed. Let's say you buy your home and the taxes are $8,000 a year. A few years go by, home values in your neighborhood skyrocket. The city assessor drives by, looks at the recent sales, and decides your home is now worth more. They send you a letter. Your home's assessed value has increased. And just like that, your tax bill jumps to $10,000 a year. Your lender gets that new, higher bill from the county, and your monthly escrow payment has to go up to cover it. This is the silent creep that catches so many homeowners off guard. Now for the second piece of the escrow puzzle: homeowners insurance. This is mandatory. No lender will give you a mortgage without proof that you have a policy in place. While most people think of it as fire insurance, it covers so much more. It's typically broken down into a few key areas. First, dwelling coverage. This is what rebuilds your house if it's damaged by a covered peril, like a fire, a hurricane, a tornado, or a heavy hailstorm. Second, personal property coverage. This replaces your stuff, your furniture, your clothes, your electronics, if it's destroyed or stolen. And third, and this is one people often forget, liability coverage. This is your financial defense if someone is injured on your property. A delivery driver slips on your icy porch. A guest child falls out of your treehouse. Your dog bites the mailman. A lawsuit from something like that could bankrupt you. Your homeowner's insurance is what stands between you and financial ruin. Just like property taxes, the cost of homeowner's insurance is all about location and risk. A $600,000 house in a low-risk area in the Midwest might cost $1,000 a year to insure. That's less than $100 a month. But take that same house and put it in Florida's Hurricane Alley, California's wildfire zones, or Oklahoma's tornado belt. The risk skyrockets and so does the premium. Could be $5,000, $6,000, $7,000 a year or even more. In some high-risk areas, it's becoming difficult to get insurance at all. Other factors play a role too. The age of the home, the type of construction, the condition of the roof, whether you have a pool or a trampoline, and even your personal credit score. And just like taxes, insurance premiums almost never go down. They climb. The cost of lumber, roofing, and labor to rebuild a home is constantly increasing. Climate change is leading to more frequent and severe weather events, which means more claims, which means insurance companies raise their rates for everyone to cover those losses. So that $1,000 a year policy might be $1,200 next year, and $1,500 the year after. It's another variable, another rising cost that directly impacts your monthly payment. So you have these two constantly changing costs, property taxes and homeowner's insurance, being managed by your lender in this escrow account. Here's how it leads to the dreaded payment shock. At the end of every year, your lender performs what's called an escrow analysis. They look at the bucket of money you've been paying into, and they compare it to the actual bills they had to pay on your behalf. Let's say they projected your total annual cost for taxes and insurance would be $6,000. So, they collected $500 from you each month. But during the year, your property taxes were reassessed, and your bill went up by $600. And your insurance company raised your annual premium by another $600. Your actual costs for the year weren't $6,000, they were $7,200. The lender paid those bills, but you only gave them $6,000. You are now $1,200 short. This is called an escrow shortage, and you have to pay it back. The lender will typically give you two options. You can either write them a check for the full $1,200 right now, which most people can't do, or they'll do the more common thing. They'll spread that shortage over your next 12 mortgage payments. So $100 a month will be added to your payment just to cover last year's deficit. But that's only half the hit. The lender also has to adjust your payment for the coming year. They now know your annual costs are $7,200, not $6,000. So your new base escrow payment needs to be $600 a month, not $500. So what happens? Your monthly payment goes up by $100 to cover the shortage, and it goes up by another $100 for the new, higher base payment. Your mortgage payment just jumped by $200 a month, seemingly out of nowhere. You didn't refinance, you didn't miss a payment, but your bill is significantly higher. This is the escrow nightmare in a nutshell. And it happens to millions of homeowners every single year. Your fixed-rate mortgage isn't really fixed. The P&I part is, but the T&I, the taxes and insurance, are a constantly moving target, and you're the one who has to absorb the changes. So we've cracked open the PITI payment. But here's the scary part. PITI is just the beginning. It's what you pay the bank. It's not the true cost of owning that $600,000 house. There are thousands, sometimes tens of thousands of dollars in other costs every single year that nobody ever prepares you for. And in the next part, we're going to uncover every single one of them. So let's talk about the silent budget killers. The financial landmines buried in your perfect green lawn. Because your mortgage payment, that clean PITI number we calculated, is like the price on the sticker of a car. It's just the starting point. The true cost of ownership, the number that actually hits your bank account, is often thousands of dollars higher every single year. First, and most importantly, is the monster under the bed of every homeowner: maintenance and repairs. When you're a renter and the dishwasher starts making a sound like a dying walrus, you call the landlord. It's an inconvenience. When you're a homeowner, it's a four-figure problem that's entirely yours. Financial experts have a rule of thumb for this, the 1% rule. It states that you should budget at a minimum 1% of your home's value for annual maintenance. On a $600,000 house, that's $6,000 a year. Or, to put it in monthly terms, that's another $500 added to your budget every single month. Now you might be thinking, $500 a month? My house is in great shape. And for a few months, maybe even a year, you might get lucky. You'll spend a little here on a new faucet, a little there to have a professional snake a clogged drain. But that $500 isn't just for the small stuff. It's a war chest. It's an average. Because the big-ticket items don't ask for permission before they fail. Imagine this. You buy your beautiful $600,000 home in May. You have a housewarming party in June. It's perfect. Then, in the middle of a brutal July heat wave in Texas or Florida, the air conditioning unit gives up. Just stops. The repairman comes out, takes one look at your 15-year-old system and shakes his head. It's not a repair. It's a replacement. The quote, $10,000. Suddenly, your maintenance-free year has turned into a financial emergency. That $500 a month you should have been saving, you now need 20 months' worth, and you need it today. This isn't a scare tactic. It's the reality of owning a physical structure that is constantly at war with entropy. The roof over your head has a lifespan, typically 20 to 30 years. A new roof on a moderately sized home can easily cost $15,000 to $25,000. Your water heater? That'll last you about 10 to 12 years. That's a $1,500 to $2,500 surprise waiting for you. That 1% rule, that $500 a month, is your defense fund against the inevitable decay of your largest asset. Next up, utilities. And no, it's not the same as your apartment. Not even close. You're now heating, cooling, and lighting a much larger space. Your electricity and gas bills could easily double or triple. But it doesn't stop there. You now have a water bill that includes watering that lawn you were so proud of. You have a sewer bill. You have a trash and recycling collection bill. Depending on where you live in the United States and the size of your home, your combined utility bills can range from $300 to over $700 a month. A family in a 2,500 square foot home in a state with 4 distinct seasons can easily average $450 a month across the year. That's another line item your landlord used to cover that is now squarely on your shoulders. Then there's the part of the American dream they don't show you in the movies. Exterior upkeep and landscaping. Your curb appeal comes at a cost. That lawn needs to be mowed, fertilized, and weeded. You can spend your Saturdays doing it, which means buying and maintaining a lawnmower, a trimmer, a spreader. That's hundreds of dollars in equipment right there. Or you can hire a service which can run you $100 to $200 a month, depending on the size of your yard. Got beautiful mature trees on your property? They're gorgeous until a branch is hanging precariously over your roof or the power lines. Having a professional tree trimmer come out isn't a $100 job. It can be $1,000 or more for a single large tree. You'll also need pest control. Termites, carpenter ants, wasps. They all see your house as their next meal or home. A quarterly pest control plan can run you $400 to $600 a year. Don't forget cleaning the gutters twice a year to prevent water damage. You can do it yourself if you're comfortable on a ladder, or pay a few $100 to have someone else do it. When you average it all out, you're looking at least another $100 to $150 a month just to keep the outside of your house from falling into chaos. And for many of you buying in a newer subdivision, a condo, or a planned community, get ready for one of the most controversial costs of modern homeownership: homeowners association fees, or HOA fees. This is a mandatory monthly or annual fee you pay for the upkeep of shared amenities like a community pool, a park, or even just the landscaping in common areas. In some cases, it covers your trash service or cable. These fees can range from a modest $50 a month to an eye-watering $800 a month or more in high-end communities. For our $600,000 suburban home, let's assume a fairly standard $100 a month. But the real danger with HOAs isn't the monthly fee you can budget for. It's the dreaded special assessment. This happens when a major unexpected expense comes up for the community. The clubhouse roof needs replacing. The community pool needs to be completely resurfaced. The HOA board then divides that cost among all the homeowners. You might suddenly get a bill in the mail for $5,000 due in 90 days. It's completely out of your control. So let's stop for a second and tally up the invisible monthly costs for our $600,000 house. We have $500 for maintenance and repairs, based on the 1% rule. We have an average of $450 for utilities. We'll be conservative and say $100 for landscaping and exterior upkeep. And we'll add another $100 for a modest HOA fee. That comes to $1,150 per month. This is the number that makes people feel house poor. It's the reason why someone who was approved For a $3,500 mortgage payment feels like they are drowning, because their real payment isn't $3,500. It's closer to $4,650. And we haven't even talked about saving for the big stuff yet. This is where smart homeowners go one level deeper. They don't just budget for maintenance. They create a savings plan for capital expenditures, or CapEx. They know the roof will fail in 20 years, so they take its $20,000 replacement cost and divide it by 240 months. That's $83 a month they set aside specifically for the roof. They do the same for the $10,000 HVAC system, the $2,000 water heater, and the $5,000 they'll eventually spend on new kitchen appliances. This level of planning adds another $200 to $300 a month to your savings goals. So now, our true cost of ownership, the number you actually need to be able to afford, is our PITI payment. Let's call it $3,500, plus that $1,150 in ongoing costs, plus another $250 in smart CapEx savings. We are now at $4,900 a month. Suddenly, that $600,000 house requires an income that can support a nearly $5,000 a month housing bill, not the $3,500 the bank told you about. This is the shock that derails so many families. But what if I told you that even this all-encompassing nearly $5,000 a month number isn't the final figure? There is one last massive financial hurdle that trips up almost every single homebuyer, and it has nothing to do with your monthly payment at all. It's a five-figure expense that you have to pay before you even get the keys, and we're going to break that down next. This is the cash out-of-pocket ambush, the number that makes people's jaws hit the floor when they see it on paper for the first time. We're talking about closing costs, and for our $600,000 home, this single line item can easily demand another $12,000, $20,000, or even $30,000 in cash. That's right. On top of your $60,000 down payment, you might need to bring another $30,000 to the table just to finalize the deal. So what on earth are you paying for? Closing costs are a bucket of dozens of little fees required to make the home sale official. Think of it as the administrative and legal price of transferring a massive asset from one person to another. It's the cost of doing business in real estate. The industry rule of thumb is that you should expect to pay between 2 to 5% of the home's purchase price in closing costs. For our $600,000 house, 2% is $12,000. 5% is $30,000. This is a massive range, and it's why so many buyers get blindsided. Let's demystify this. We can group these dozens of fees into three main categories. First, you have the lender fees. This is what your bank or mortgage company charges you for the service of creating your loan. The biggest one is often the loan origination fee. This is a commission, usually around 0.5% to 1% of the loan amount. On our $540,000 loan, a 1% origination fee is $5,400 right off the top. You'll also see smaller charges like an application fee, maybe $300, and an underwriting fee, which can be $1,000. That's the fee for the professional who meticulously combs through your financial life to approve you. They also have to order an appraisal. This is non-negotiable. The bank needs a licensed appraiser to go out to the property and confirm that it's actually worth $600,000. They won't lend you the money otherwise. That appraisal will cost you about $500 to $800. Add in a credit report fee and a flood certification fee, and you're already looking at thousands of dollars just to pay the lender for their work. The second category is third-party fees. These are costs for services provided by other companies that are still required to close the deal. The giant in this category is for title services. When you buy a house, you're really buying the title to the house, which is the legal right of ownership. A title company has to perform a detailed title search, digging through historical records to make sure the person selling the house actually has the right to sell it, and that there are no old debts or liens against the property. Then, you have to buy insurance for that title. And this is where it gets tricky. You are required to buy a lender's title insurance policy. This policy protects your bank, not you. If some long-lost heir shows up years later and claims the house was rightfully theirs, the lender's policy ensures the bank gets its money back. That can cost a couple $1,000s. But what about you? To protect your own investment, your $60,000 down payment and all your future equity, you need to buy a separate owner's title insurance policy. This is technically optional, but no sane person should ever skip it. It's a one-time fee that protects you for as long as you own the home. It can cost another $1,000 or $2,000. Together, title search and insurance can easily be a $3,000 to $4,000 line item. On top of that, you might have attorney fees or settlement fees for the person or company physically conducting the closing, which can add another $1,000 or more. Now for the third and most confusing category, prepaids and escrows. This is where you're not just paying fees. You're prepaying your own future expenses. Remember that escrow account we talked about, where you pay a portion of your property taxes and homeowners insurance every month? Well, the lender needs to see that account with a cushion of money right from the start. They can't risk the account going negative. So at closing, they will require you to pay for a full year of homeowners insurance upfront. For our house, that's $1,800. Then they'll collect several months' worth of property taxes to put into escrow. If your taxes are $7,500 a year, that's $625 a month. The lender might require you to deposit 3 months' worth at closing. That's another $1,875 in cash. And there's one more sneaky prepaid item: daily mortgage interest. Your first mortgage payment isn't due on the first of the next month. It's due on the first of the month after that. So if you close on May 15th, you skip June and your first payment is July 1st. But the bank isn't going to let you live there from May 15th to May 31st for free. They're going to charge you interest for each of those days. Let's do the math. Your loan is $540,000 at 6.5% interest. That comes out to $96.16 in interest per day. If you close on the 15th of a 31-day month, you owe them for 17 days of interest. That's over $1,600 you have to pay at closing, just for the interest in that first partial month. A quick pro tip. This is why many people try to schedule their closing for the last day of the month. If you close on May 30th, you only owe 2 days of prepaid interest instead of 17. So let's add up a conservative estimate for our $600,000 house. Lender fees may be $4,000. Third-party fees like title and settlement, another $4,000. And prepaids for insurance, taxes, and interest could easily be another $5,000. That's a grand total of $13,000. And that's a conservative number. It could easily be $20,000 or more depending on your state's taxes and local fees. This is $13,000 in cash you need in your bank account, completely separate from your $60,000 down payment. You're at $73,000 in cash just to get the keys. Now, is this number set in stone? No, you have some power here. First, you can negotiate. In a buyer's market, you can ask the seller to pay a portion of your closing costs. This is called a seller concession. They might agree to pay, say, $10,000 towards your costs in exchange for you paying their asking price. This saves you a ton of cash up front. Second, you must shop around for your mortgage. Different lenders charge different origination and underwriting fees. Getting a loan estimate from at least 3 different lenders can save you thousands just by comparing their fees in Section A of the form. You can even take the best offer and ask another lender to beat it. Finally, you can ask about a no closing cost mortgage. But be very careful. Nothing is free. In this scenario, the lender pays your closing costs for you, but they charge you a significantly higher interest rate for the entire life of the loan. Over 30 years, you will pay far more in extra interest than you saved on the upfront costs. It's a trade-off that only makes sense if you are extremely short on cash and plan to sell or refinance in just a few years. So you've done it. You've saved the massive down payment. You've weathered the storm of closing costs. You've signed a mountain of paperwork, your hand is cramping, but the keys to your $600,000 home are finally in your hand. The hard part is over, right? The truth is, the most unpredictable, and for some people the most financially devastating costs of owning this house are just about to begin. We've accounted for every dollar to get you to the closing table. But what about the day after? What about the hidden costs that nobody puts on a loan estimate? The costs that can drain your savings and turn the dream of homeownership into a financial nightmare. We're breaking down that final crucial piece of the puzzle next. So let's walk through those first few weeks. You've signed a mountain of paperwork, your hand is cramping, but you have the keys. The feeling is incredible. You walk into your empty $600,000 house. The echo of your footsteps, a symphony of achievement. The first thing you do, you order a pizza and eat it on the floor. It's a classic, beautiful moment. The next morning, the reality begins to set in, not with a bang, but with 1,000 tiny cuts to your bank account. First, the movers. The quote was for $2,000, but because it took an extra hour and they had to use more packing tape than expected, the final bill is $2,400. A small hit, but it's the first of many. Then you call to set up the internet. There's a $75 installation fee. The electric company needs a $200 deposit for a new account. The water and gas companies have similar transfer fees. Before you've even spent a single night, you're already down another $500 you didn't explicitly budget for. And you need to change the locks. You have no idea who the previous owners gave copies of the keys to. A locksmith comes out. That's another $250. You realize the sellers, bless their hearts, didn't exactly do a deep clean on their way out. You spend a full weekend scrubbing, but ultimately decide to hire a professional cleaning service to get into every nook and cranny. That's $400. All told, in the first 72 hours of homeownership, you've spent over $1,000 on things that have nothing to do with your mortgage payment. Then the second wave hits. This is the settling in phase. You realize that the beautiful stainless steel refrigerator the sellers left behind makes a weird humming noise and doesn't seem to be keeping the milk quite cold enough. You look it up. It's a 12-year-old model notorious for compressor failure. A new comparable fridge? $1,500 to $2,000. That gorgeous bay window in the living room? It's perfect, except it's a giant wall of glass with no privacy. You need curtains or blinds. For a window that size, custom treatments can easily run you another $1,000. You go to mow the lawn for the first time and realize you don't own a lawnmower, or a weed whacker, or a rake. A trip to the hardware store results in a $500 lawn care starter pack. And as you're mowing, you notice one of the gutters is sagging. You get up on a ladder and see it's clogged with years of debris. You spend an afternoon cleaning them, but you know this is a job you'll have to do twice a year every year, or pay someone a few $100 to do it for you. These aren't disasters. They're just ownership. This is the stuff that a landlord would have handled. But now you are the landlord. That slow drip under the bathroom sink isn't just an annoyance anymore. It's a ticking clock on your wallet. A plumber's visit, even for a simple fix, is a minimum of $150. This brings us to the single most overlooked cost of homeownership: ongoing maintenance and repairs. Financial experts have a rule of thumb for this, and it's a number that shocks most first-time buyers. They recommend you budget and set aside between 1% and 4% of your home's value every single year for maintenance. Let's stop and really process that. For your $600,000 home, 1% is $6,000 a year. 4% is $24,000 a year. Let's be conservative and meet in the middle at 2%. That's $12,000 a year. That is an extra $1,000 per month. $1,000 every single month that you need to be saving purely for the upkeep of your home. This isn't for upgrades. This isn't for a new kitchen or a fancy deck. This is for the boring stuff. The stuff that simply keeps your house from falling apart. What does that money cover? It covers the big-ticket items that have a finite lifespan. A new roof doesn't last forever. The average cost to replace a roof in the U.S. is anywhere from $8,000 to $15,000. Your HVAC system, your furnace and air conditioner, they last about 15 to 20 years. A new system can cost $10,000 or more. A water heater? You'll get maybe 10 years out of it. That's a $2,000 replacement. Painting the exterior of your house to protect the wood from the elements? $5,000 to $7,000. So that $1,000 a month you're saving? It's not a slush fund. It's an inevitability fund. It's the money that will sit there, waiting for the day your air conditioner dies in the middle of a July heat wave, or the day a freak hailstorm shreds your roof. When those things happen, it's not a question of if you'll pay, but how you'll pay. Having that fund is the difference between a manageable inconvenience and a full-blown financial crisis that forces you into high-interest debt. So let's put it all together. Let's recalculate the true monthly cost of this $600,000 home. We started with our baseline PITI payment. Using our example of a 6.5% interest rate, that was about $3,800 a month. Then we added private mortgage insurance because we put down less than 20%. That was another $300 a month, bringing us to $4,100. Now we add the invisible cost, the 1 to 4% rule. Let's stick with our conservative 2%, or $1,000 a month, that you must be setting aside for future maintenance and repairs. Suddenly, the real cost to live in and maintain this house isn't $3,800. It's not even $4,100. It's $5,100 per month. That is a $1,300 difference between the number on the mortgage calculator and the number you actually need to have in your budget to own this home responsibly, without being one broken appliance away from disaster. And we haven't even talked about potential HOA fees, which could add another several $100s on top of that. We haven't talked about furnishing the house, or the inevitable increase in your utility bills from moving to a larger space. The goal here is not to scare you out of buying a home. Absolutely not. The goal is to arm you with the truth. Because the people who get into financial trouble with homeownership are the ones who only plan for the PITI. They are the ones who are blindsided by a $5,000 plumbing repair and have to put it on a credit card. So how do you prepare for this? First, before you even start looking at houses, you need to build what I call a homeownership fund. This is separate from your down payment and separate from your 6-month emergency fund. This is a fund specifically for moving costs, immediate repairs, new furniture, and to kickstart that critical maintenance savings. Having an extra $10,000 to $20,000 liquid in the bank on closing day will transform your first year of homeownership from a period of stress into a period of joy. Second, take the home inspection incredibly seriously. It's not just a box to check. It's your best negotiation tool. If the inspector says the water heater is 12 years old and on its last legs, don't just accept that. Ask the seller for a $2,000 credit at closing to cover its imminent replacement. Use that report to chip away at your future costs before they even happen. And finally, when you think about how much house you can afford, don't just use the bank's pre-approval number. That number is designed to tell you the maximum you can borrow, not the maximum you can comfortably live with. Do the real math yourself. Calculate PITI, estimate PMI, and then add at least 1.5% of the home's value, divided by 12, to your monthly payment. That final number is your true cost. If that number makes you break out in a cold sweat, you need to be looking at a lower price point. Owning a home can be one of the most rewarding experiences of your life. It is a cornerstone of wealth building and a place to create lasting memories. But the dream only works if it's built on a foundation of financial reality. Understanding the true all-in cost of that $600,000 mortgage, that $5,100 a month or more, is the single most important step you can take. It's the knowledge that empowers you to move beyond just paying your mortgage and to truly thrive as a homeowner. If this breakdown provided you with real value and opened your eyes to the true costs, do me a favor and hit that like button and subscribe to the channel for more deep dives just like this one. And I want to hear from you in the comments. For the current homeowners, what was the most unexpected expense you faced in your first year? And for the aspiring buyers, what part of this breakdown surprised you the most? Let's share our knowledge and help everyone make smarter decisions. Thank you for watching.